SPGI is a company you need to have on your watch list. It outperforms the S&P 500 with incredible growth. We're going to take a look at this stock in detail. You're going to understand the numbers behind the company. We're going to take a look at the historical performance of the company, look at the income statements, their revenues year on year, look at that bottom line net income. We're going to look at the balance sheet, look at their total cash versus their total debt. As always, we're going to look at that dividend safety, some very important financial metrics for S&P Global. And you know it, that stock valuation model, we're going to run it through, look at the intrinsic value and find out our acceptable buy price of this incredible company given our margin of safety. Now, S&P Global is year to date up 18%, which is roughly a few percentage points below the S&P 500. We can see it is towards the mid to upper end of the 52-week range and does offer a yield of just below 1%. Now, the incredible thing about this company, if we look at the 10-year growth, up 528% over the last 10 years without dividends reinvested. Just look at the growth of this company, that upwards trajectory. And what we want to understand in today's episode is, can we get this at a very good price? Lock in this yield, which will only increase that yield on cost over time, as well as the growth of the share price. Now, revenues year on year, typically 3 to 7% is what we like to see for steady growth. December 2018, they reported 6.3 billion in revenue. 5 years later, December 2022, 11.2 billion. So nearly double over the last 5 years. And we can see that increase year on year with that explosive increase December 21 to 22. Now, how has that affected the bottom line, their net income? Well, we can see here, December 2018, 1.96 billion on that bottom line. December 22, 3.25 billion. Now, one thing I love about a company, not only do they increase their revenue year on year, but look at the consistency that year on year with the net income. We have reviewed many stocks on this channel where their revenues and their net incomes do not correlate. So it is great to see increasing revenues and increasing bottom line net income. Now, what I love to see very briefly is their total cash and short-term investments versus their total debt. December 2018, 1.9 billion. Latest quarterly report, 1.6 billion. So fairly flat over the last 5 years in terms of the growth. Not necessarily a red flag indicator at all, but it is good to know how that compares to the movement in the total debt. Now, total debt, we can see here 3.7 billion in December 2018. Latest quarterly report up nearly 4 times as much at 12.2 billion. Not necessarily what I like to see, a small decrease in their cash balance with a very large increase in their total debt. But it is not the end of the world, and that's why we look at the dividend safety alongside some very important financial metrics of S&P Global to understand if it is a good company. Dividend safety straight off the bat, 99, very safe. You cannot get a better score. Market cap 127 billion, making a mega cap company. So starting off very, very well. Few key metrics for people who believe we're heading into a recession. Well, look, recession dividend, they increased it during the last recessionary period, 07-09. Unfortunately, negative 38% in sales, which was below the average growth rate during the recession, which was in fact also negative. One thing to point out here, dividend streak, they have been paying dividends increasing year on year for 49 years. Now, what is the significance of that? When it becomes 50 years, which will be this year, they will become a dividend king. 50 years or more of increases in dividend will give them that dividend king status. Now, we can see here, dividend growth streak, 49 years, as I mentioned. So actually, in fact, January 24, we will be expecting them to increase that dividend again, and they will enter that dividend king status. Last 5 years, 15% growth year on year. Last 20 years, 10%. Very nice to see. What I love to see with my dividends over this period, double digits, meaning it's beating inflation, which has been 4% over the last 40 years in the US. And it means you're not losing your purchasing power. As I always say, you want 4% or more in your salary, dividends, other income producing assets, so as not to lose purchasing power and take a pay cut. Now, dividend yield theory states that a company is undervalued when the current yield sits above the 5-year average. What we can see, in fact, is bang on that 5-year average, showing a sign of reasonable valuation. Likewise, the forward PE is fairly in line with the 5-year average of 28.1. And what we can see here is it is much higher than the sector PE, currently for the financials at 10.5. Now, I always say this, no matter where the stock is in this 52-week price range, it has nothing to do with overvaluation or undervaluation. So as we see, it's near the 52-week high. This does not signal overvaluation. Likewise, at the other end, it would not signal undervaluation. You hear me say it many, many times. Earnings is susceptible to manipulation by management through accounting. So if you can, do avoid using this and look at the free cash flow payout ratio instead. Below 60% is what I like to see, as it means there's room to grow that dividend, give us that double-digit increase we like to see year on year, and is one of my 7 golden dividend metrics. If you want to see the other 6, do go check out my pinned YouTube video. Now, finally, the last 10 years, if we do exclude 2015 and 2013, 8 out of the last 10 years have in fact been below 60%, and what we can see, it has even been around the 20%. 2022, it was 42%. 2023 is expected to be 24%. So very, very positive. Gives me a lot of faith in that dividend safety, and we can see why it was given a 99 score. Combine that with the free cash flow per share. Again, I prefer that over the earnings per share. 158 in 2013, 793 in 2022. I love that increase. Granted, we can see that decrease from 21 to 22, but this is why I like to see at least 10 years worth of data to get a better view on a business's operations. 2023, however, is expected to rocket up to 15.2, which is higher than 2020 and 21, so continues that upwards trajectory, which is a very strong plus. Sales growth 3 to 7% is what I asked for in these companies. Now, what we can see here, for the large part, they have got 7% plus, so very, very strong to see. 4.7 billion sales in 2013, 11.2 in 2022, nearly triple over the last 10 years and very consistent in their increases. So I do love to see this with a company. Now, a bit of a funny story here. You know we love it when companies return excess cash to our shareholders by doing share buybacks. 2013 to 2021, they've effectively done that very consistently, but very, very small year on year. 2021 to 2022, they did the opposite and in fact issued shares, which is a shame as it does dilute your ownership as a shareholder. And in fact, they brought it to higher than the 2013 point in terms of shares outstanding. Issue with this is, for me, if they've done it once before, they are very likely to do it again if needed. Return on invested capital, again, another one of my 7 golden dividend metrics. What I like to see is 10% plus. Gives me faith in management and their ability to effectively allocate their capital. 2022, interestingly enough, was very inconsistent with the last 9 years where it was hovering between 40 to 50%. I would like to see 2023 go up above 10% and maybe gradually back in line with the 40%. But this is 10 years worth of data we are looking at, so for me, I would say this is very positive to see. Operating margin, absolutely killing it. Over 12% is what we like to see. It is consistently gone up. 2022, we did see a drop. So I would like at least for it in 2023 to stabilize or go back up to the levels previously seen. Similarly with free cash flow, again, very, very positive, over 5%. This is very, very good to see in terms of analyzing stocks with that free cash flow margin. So I have to say, very positive. Net debt to earnings for interest, tax, depreciation, amortization. As I mentioned, when we looked at the balance sheet, it had increased quite significantly, but this gives us faith that there are no real issues. 2022, it would have taken SPGI 1.86 years to essentially pay off their debt net of cash on hand. 2023, it is expected to come down to 1.69. So again, very positive to see. And this graph is showing us that 21% of the company's financing is from debt as opposed to equity. As always, if value is being provided, do hit that like button, do subscribe for more content directly on your channel and on your doorstep. If you do essentially want to run your own companies through the stock valuation model, do check the pinned comment below. SPGI, the earnings per share at 8.18, growth rate as expected by analyst estimates at 20, current yield on AAA corporate bond at 4.75, intrinsic value coming in at $205. We can see that is significantly lower than the current trading price and well below the 52-week range, showing significant signs of overvaluation. We then have companies in a similar sector and size for the multiples valuation model. We have Moody's Corporation and MSCI Inc. Stock price, earnings per share, giving us their PE multiple. Average PE multiplied by the earnings per share to give a multiples valuation price of $391. And we can see fairly in line with the current trading price. Now, dividend discount model, we have the yearly dividends we can see here on the screen. Average growth rate very strong at just over 12.5%. Forward looking, I've gone for around 7.25%. You could really justify slightly higher. You could maybe justify slightly lower given the last increase this year at 5.8%. So really it could work both ways. However, I've gone for 7.25. This gives a DDM price of $514, showing significant upside to that current share price and showing a lot of room to grow above the 52-week high. We then move on to the discounted cash flow. Year on year, we can see here, average growth rate at 69.7, with analysts estimating between 20 to 25% growth. With our discount rate at 8%, this gives the present value of our future free cash flows and terminal value. Add that together with the cash, subtract the total debt, and we get to our equity value. Divided by the shares outstanding gives a DCF price of $550, again showing some really strong upside to that current share price and showing significant room for growth above the 52-week high. As always, do hit that like button if you are enjoying the content, and do subscribe for more content directly on your channel. Now, essentially here, the intrinsic value is coming at around $415. And what we can see in terms of the current price is trading at around $394. So typically for a company with a wide moat, strong financial metrics, and forward-looking guidance, I would be looking for a margin of safety at around 10%. Now 10% would mean this is a buy at around $373. And people could argue again a bit higher of a margin of safety at around 15%. Around $352. Now we can take a look at that 52-week range, and that is still within that 52-week range. For people looking for a 20% margin of safety, $330, we can see still again within that range given how it has increased over the last year. Now personally, I'll be looking for a margin of safety at 10%, and it will be on the watch list at $375, where I typically will pick up a share and then dollar cost average if it does decrease. Wall Street do forecast the price over the next 12 months to actually be higher than the intrinsic value we've calculated at $451. As always, let me know your thoughts in the comments. Are you a shareholder? Are you looking to buy, looking to sell, or purely on the sidelines? And as always, have a great day. Don't forget to like, subscribe, catch you on the next episode, and take care.